September 15, 2008. Outside a glass tower in Manhattan, employees walk out carrying cardboard boxes, framed photos, coffee mugs, nameplates pulled off desks, cameras surround them. By nightfall, the firm they worked for no longer exists. Lehman Brothers had survived the Civil War. It had survived 2 world wars. It had survived the Great Depression. 158 years of history, and it took less than a weekend to end it. $639 billion in assets gone into the largest bankruptcy filing in American history. 25,000 jobs disappeared overnight. Markets around the world would spend the next year in freefall because of what happened inside that building. But to understand how it all fell apart, you have to go back to the beginning, to 1850, and a small dry goods store in Montgomery, Alabama. In 1850, 3 brothers arrived in Montgomery, Alabama from Bavaria. Henry, Emanuel, and Mayer Lehman were German Jewish immigrants with almost nothing, and they opened a dry goods store selling cloth, tools, and supplies to local farmers and planters. Cash was scarce in the cotton economy of the American South, so the Lehmans began taking cotton itself as payment. It was a small adjustment that changed everything. They started grading it, trading it, brokering it between farmers and buyers. Within a few years, the store was a side business. The real business was cotton. By 1858, the brothers had opened an office in New York, the center of American finance and shipping. They helped found the New York Cotton Exchange, giving the chaotic regional cotton trade a formal marketplace with standardized rules. The store in Montgomery closed. The Lehman name moved north for good. What followed was nearly a century and a half of steady, almost stubborn endurance. Lehman Brothers financed railroads as America expanded west. It helped underwrite some of the country's first retail giants and industrial companies. It survived the Civil War, when the cotton trade that built the firm was thrown into chaos. It survived the panics and recessions of the late 1800s. It survived the Great Depression, when thousands of banks failed outright by shifting toward investment banking and advisory work rather than risky speculation. It survived 2 world wars, come out the other side each time still standing, still trading, still Lehman. By the second half of the 20th century, Lehman Brothers was a fixture of Wall Street. It built a reputation as a serious blue-chip investment bank, one of the names that belonged in the same sentence as Goldman Sachs and Morgan Stanley. It advised governments, underwrote bonds, and moved billions of dollars for corporations. Generations of ambitious young bankers came through its doors. To work at Lehman was to be inside the American financial establishment. By 2008, that establishment position had translated into scale. Lehman Brothers was the 4th largest investment bank in the United States, trailing only Goldman Sachs, Morgan Stanley, and Merrill Lynch. It employed roughly 25,000 people across offices worldwide. It had weathered wars, depressions, and a century and a half of American economic upheaval without disappearing. That survival record became part of the firm's identity. Lehman had a habit of coming through crises that killed other institutions. Inside the company and across Wall Street, that history bred a certain confidence. If Lehman had outlasted the Civil War and the Depression, what exactly was going to bring it down now? That question would soon have an answer nobody at the firm wanted to hear. The man running Lehman Brothers by the 2000s was Richard Fuld, a chief executive who had spent his entire career at the firm and led it for over a decade. Fuld was famous on Wall Street for his intensity and for a leadership style that rewarded aggression and loyalty to his vision. Under him, Lehman didn't just participate in the American housing boom of the early 2000s. It leaned into it harder than almost anyone. Mortgage-backed securities, financial products built by bundling thousands of home loans together and selling slices of them to investors were the engine of the era's profits. Lehman didn't just trade these products. It bought mortgage originators outright, companies that made the loans in the first place so it could control the entire pipeline from a family signing papers on a house to a bond being sold to a pension fund on the other side of the world. Subprime lending, loans made to borrowers with weak credit, was a fast-growing, highly profitable corner of that pipeline, and Lehman pushed deeper into it than most of its rivals. The profits were extraordinary, and for years the strategy looked less like recklessness and more like foresight. Revenue climbed. Fuld was celebrated in the financial press as one of the most successful bank chiefs on Wall Street. But underneath the profits sat a structural decision that would prove far more dangerous than any single bad loan: leverage. Leverage is simply the ratio of what a firm owns to what a firm actually has in its own capital, the money that belongs to the firm itself, rather than borrowed money. A conservative bank might operate with modest leverage, borrowing a few dollars for every dollar of its own. Lehman Brothers, at the peak of the boom, was widely reported to be operating at a leverage ratio of around 30-1. For every dollar the firm truly owned, it had borrowed roughly 30 more to fund its assets and bets. At 30-1, a firm doesn't need a catastrophe to become insolvent. It needs a modest decline. If the value of Lehman's assets fell by just a few percentage points, the firm's own capital, the thin cushion behind all that borrowing, could be wiped out entirely. It was a structure built for a world where housing prices only went up. Few people outside the firm, and perhaps not enough people inside it, grasped how thin that cushion really was. Lehman kept buying mortgage-related assets even as some competitors began quietly pulling back. Warnings from risk managers when they came were reportedly overridden or downplayed. The firm's success had become self-reinforcing evidence that its strategy was sound. Nobody wanted to be the person who called time on the profits. Then, starting in 2007, the American housing market began to turn. The cracks in the American housing market widened fast. Home prices, which had climbed for years, began falling in city after city starting in 2007. Borrowers who had taken out subprime loans, many with little ability to repay them once low introductory rates expired, started defaulting in large numbers. The mortgage-backed securities that firms like Lehman had bundled and sold started losing value, and no one could say with confidence what they were actually worth anymore. For Lehman, this wasn't a peripheral problem. Mortgage-related assets sat at the center of its balance sheet, and with $30 of borrowing behind every dollar of real capital, even a modest write-down in value threatened to erase the firm's cushion entirely. Through 2007 and into 2008, Lehman reported mounting losses tied to these assets. Investors and other banks began asking an uncomfortable question. If Lehman's mortgage portfolio was worth this much less than advertised, was the firm actually solvent at all? Confidence in banking is the whole business. Once other institutions start doubting whether a bank can pay its debts, they stop lending to it, stop trading with it, and start pulling money out. Through the summer of 2008, that's exactly what happened to Lehman. Its stock price fell sharply. Credit rating agencies grew skeptical. Counterparties who normally did business with Lehman every single day began demanding more collateral or refusing to deal with the firm at all. Richard Fuld and Lehman's leadership scrambled for a lifeline. They needed either a buyer willing to absorb the firm's toxic mortgage exposure or a government-backed rescue similar to the one that had helped stabilize Bear Stearns, another investment bank, earlier that year. Through the second week of September 2008, federal regulators and the heads of major banks held emergency meetings in New York trying to broker a deal before markets opened Monday. Barclays, the British bank, looked at Lehman's books and walked away, reportedly deterred in part by the difficulty of getting a deal approved fast enough. Bank of America looked too and also walked away, choosing instead to acquire the troubled brokerage Merrill Lynch. The U.S. government, having intervened for Bear Stearns and about to intervene for mortgage giants Fannie Mae and Freddie Mac, decided this time it would not put public money behind a rescue. There would be no buyer, there would be no bailout. With no other options left, Lehman Brothers filed for Chapter 11 bankruptcy protection in the early hours of September 15, 2008. The filing listed roughly $639 billion in assets against $613 billion in debts. It remains the largest bankruptcy filing in United States history. Inside Lehman's offices worldwide, employees who had gone to sleep the night before working for one of Wall Street's oldest firms woke up to find it had ceased to exist. Around 25,000 people lost their jobs. Markets around the world, already jittery from a year of mortgage-related fear, went into freefall, and the collapse became the defining moment of what the world would come to call the global financial crisis. Within days, Lehman Brothers was carved up and sold in pieces. Barclays acquired Lehman's main U.S. operations, including its Manhattan headquarters, absorbing thousands of employees and the trading business almost overnight. Nomura, the Japanese bank, bought Lehman's operations across Europe and Asia. The name Lehman Brothers, 158 years in the making, was gone from Wall Street within a week, its people and desks simply relabeled under new owners. The wider damage took much longer to settle. Lehman's collapse tipped credit markets that were already fragile into genuine panic. Banks around the world stopped trusting each other's balance sheets. Governments in the United States and Europe were forced into extraordinary interventions, bailouts, and stimulus programs to stop a full-blown depression. Millions of people lost jobs and homes in the recession that followed. Economists and regulators would spend years afterward tracing how much of that damage could be attributed to the specific moment Lehman was allowed to fail rather than being rescued like other institutions. Richard Fuld stepped down, testified before Congress about what had happened inside the firm, and became one of the most publicly blamed figures of the crisis, though he was never criminally charged. He largely disappeared from public life afterward. Many of Lehman's former executives and traders resurfaced at other banks and hedge funds in the years that followed, the talent scattering even as the institution vanished. What remains of Lehman Brothers today exists mostly as a case study, taught in business schools as the textbook example of leverage taken too far, and of what happens when an institution's confidence in its own survival outpaces its understanding of its own risk. The firm had outlasted a civil war, 2 world wars, and a depression by adapting when the world around it changed. In the end, what it couldn't survive was a bet it made on itself, $1 of its own for every 30 it borrowed, in a market that everyone assumed could only go up. A bank that measured its endurance in centuries was undone in a single weekend, not by an outside enemy, but by its own balance sheet.